Welcome back to the Fire Grind. On this channel, we talk about personal finance with a focus on the stock market. In today's video, we'll be going over WELL Health Technologies, which is a rising star on the TSX. This company owns and operates medical clinics as well as develops electronic medical record or EMR software. The software side of the business is the most exciting part as it helps develop interoperabilities between their clinics within their own network as well as within the larger Canadian network of healthcare clinics. So in this video, I'll be covering the following things on WELL Health Technologies. First of all, we'll go over the general overview of what the company does as a business. Then we're going to talk about the current market conditions that they're operating within. Then we're going to go over the financial health of the company to see if they have a sustainable business. Then the second last thing I'll talk about is the macroeconomic trends as well as the qualitative analysis of the company. And lastly, I'll give my opinion on the company and whether I'm buying the stock or currently hold a position in it. If you like these stock analysis videos I do, leave a comment down below with other stocks that you want me to analyze, as well as smash the thumbs up button and subscribe to support my channel. So now diving into what WELL Health does as a business. And the first thing that we should really look at is what's the mission statement of the company. And the mission statement of this company is that they're trying to drive interoperability between the whole network of medical clinics, as well as bring digitization into their operations. And how WELL Health is achieving the digitization of the whole medical industry is first by tackling electronic medical records. So they currently create a software that helps physicians to record down patient data in an electronic form, rather than the traditional way of pen and paper and storing this paper in the filing cabinet or on the wall on a bookshelf. So they are the third largest EMR or electronic medical record provider in Canada, and this happened through 3 acquisitions throughout 2019. And it's crazy how they became the third largest provider in 1 year. And to continue increasing the lead, they've made another 3 acquisitions already in 2020 to bring their total acquisition of EMR providers up to 6. Their technology is based on OSCAR, which is a technology developed at McMaster University. OSCAR stands for Open Source Application and Resource. And this currently is about 20% of the EMR market. Their software currently services 1,500 clinics as well as 8,000 practitioners within Canada. They also launched their Virtual Clinic Plus software this year, March of 2020, just as the pandemic hit. And this allows patients to contact their doctors through video chat, audio calls, or just secure messaging. On the clinic side of the business, they're currently the 4th largest clinic owner as of January 2020, and possibly even 3rd with their latest 2 acquisitions. The 2 largest chains currently in Canada hold about 30 to 40 clinics, so WELL Health Technologies is not very far behind. And most of their acquisitions of medical clinics were actually done in 2018. And in 2018 alone, their stats for number of patients visits was about 600,000, and they had 180 practitioners within their health clinics. Now I want to give a bit of history about the track record of the company. They were listed on the TSX Venture before January of this year when they graduated to the TSX. And from 2017 to 2019, they were in the top 50 companies on the TSX Venture. They were able to acquire all 21 clinics within 2 years, and really they acquired 19 of them within 1 full year. And they also acquired 6 OSCAR EMR companies within a year and a half. And this is amazing for a company of their size in such a highly fragmented market. And it's amazing to think within 2 years, they become the 4th largest medical clinic owners, as well as the 3rd largest EMR software company in Canada. And this speaks to the caliber of their management team. The current CEO, Hamad, was actually the CEO of TO Networks, which was a company that I owned back in 2016 and 2017. And this company got bought out by PayPal for $304 million. So CEO has a track record of successfully running a company and exiting. I don't believe that he plans to exit WELL Health Technologies by selling it to another company, although it's very possible. It seems like he does have a vision for the company though, to drive forward and become a key player in Canada's medical system. Now let's talk a bit about the current market conditions within Canada. So I want to ask you a quick question. When was the last time that you booked your doctor's appointment either through an app or by email? And I think most of you agree you've never done that before. And if you haven't done so, smash the thumbs up button so that we get an idea of how many people who have watched this video have never actually booked a doctor's appointment through any sort of technological means. Rather, the typical way of booking a doctor's appointment is to pick up the good old phone and give them a call. And if you're like me and my doctor who doesn't pick up the phone, you actually have to go to the doctor's office and sit there in line to book that doctor's appointment for maybe a month down the road. So you can see the system for booking appointments is already archaic. And now switching over to how doctors do the recording of patient records. For me, when I go to my doctor, he just brings in a file with a piece of paper and he writes down all his notes on there. And even if I go to my physiotherapist, she has a little folder with a history of all my files there, and she also marks it by pen and paper. And with pen and paper, the only way to transfer information that these doctors know is by fax. They don't even do it by email. So they could technically scan it and email it, but they decide to do it by fax. And how many of you use fax? I'm gonna guess maybe 1% of you. So you can see that this whole medical space is not very technologically advanced, and there's a lot of room for growth for technology in the medical space in Canada. Currently, if we look at the market, it's very fragmented. There's a lot of one-off medical clinics, as well as small little chains that maybe own 2 to 3 clinics out there. However, there aren't many big clinic chains out there, and the fact that WELL Health was able to become the 4th largest chain in Canada with only 1 year of acquisitions, this shows how fragmented the market is. And technology requires education and scale in order to penetrate the market further. However, the fact that senior doctors currently tend to be the ones that are making decisions in these businesses, and they're not very technologically advanced, these medical clinics aren't able to bring in software because those doctors aren't aware or don't want to use the software. However, as new grads continue to move up in the ranks in the medical space, they're going to bring technologies into their practices when they become the boss. So I think it's only a matter of time before technology adoption becomes larger in this market, and as well as when the whole medical clinic space continues to consolidate, I think it'll make a lot more sense for technology to penetrate into the medical clinic space. The Canada Care Delivery market that WELL Health Technologies is tackling is worth $242 billion, and 15.4% of this is actually just your physician care, and that's roughly equal to $40 billion. So this market opportunity is massive compared to the market cap of WELL Health Technologies, which is only $330 million today. And a bit of history about the virtual care industry in Canada. Canada used to be at the forefront of this 30 years ago, when we first introduced telemedicine. However, since then, this technology didn't seem to really adapt, and people ended up not using it very much, because as of today, about 1% of Canadians report using some sort of virtual care or online portal provided by physicians. However, this number actually is a lot smaller in terms of the number of interactions that are done virtually online. And this is 0.15% of interactions between patients and physicians are done virtually. And this is compared to the United States, our neighbors down in the south, who reports 50% of their patient and physician interactions are actually done online. And this company is Kaiser. There's a statistic reported by this other article showing that Canada ranked last amongst the 11 top earning countries for virtual communication between patients and care providers. So this is a communication aspect, like how they book appointments. Only 22% of doctors' offices that were surveyed actually used email communication. And the fact that Canada invested $2.5 billion to advance information technology in the healthcare space and only has this to show for it, this is very poor results. And I think this is largely due to the whole publicly funded healthcare system and all the regulations that we have as a medical system that are preventing innovation in the space. A lot of the practitioners out there don't have any incentive to bring technology into their businesses because their pay is essentially capped by the number of patients that they see. They don't really care about the efficiencies in their businesses because a lot of them actually run side businesses on top of that. My doctor personally, he does his own plastic surgery business on the side, and he just keeps his doctor license up just to be registered with the Canadian government. And this is one of the biggest downfalls of a publicly funded healthcare system. Now let's dive into the financials of this company to see whether they're in a healthy position to weather this storm that's coming on from the pandemic that's happening right now. So if we look at their balance sheet, they have $17.5 million in cash, and for a company of $330 million market cap, this is not too bad. They have a current ratio of 2.4, which is actually fairly good. A current ratio of 2 and above is very healthy for a company right now. And their cash ratio is 2.01. So this cash ratio is their cash to current liabilities, and this is a very healthy cash ratio. They have 3 streams of revenue that they report on their income statement. They have an insurance paid segment, which is their largest segment of revenue, and this insured revenue comes from the government paying clinics for offering services to clients. And these are things like just your regular doctor's appointments or different things like blood tests. However, they have a second business, which is the non-insured healthcare services. And these are services such as sleep doctors, which analyze your sleep, and this is not covered by the Canadian government. Other services such as physiotherapies and chiropractors also fall into this category. And their last segment of revenue is their SaaS digital segment. And this is essentially their EMR segment. This is where they license out their software to doctors and clinics. If we look at their revenue growth, their revenue grew about 38% from Q1 of 2020 compared to Q1 of 2019. This growth actually slowed down dramatically if we compare these to the 2019 numbers. In 2019 Q4, their revenue grew 84% from the year before. In Q3, it grew 328%. In Q2, it grew 258%. And in Q1, it grew 285%. So they had stellar revenue growth in 2019. And we'll look into why. But the overall revenue growth for 2019 compared to 2018 was 210%, which is very solid. The reason why the revenue stalled in 2020 is because in the early half of 2019, they made most of their clinic acquisitions, and their clinic revenue, their insured revenue portion, is their largest portion of revenue. So the fact that they had no clinics in 2018 for most of the year to having 19 clinics or so in 2019, we're definitely going to see a huge boost in revenue. If we look at their SaaS business and how that's growing, that's where the excitement comes in. The year over year from Q1 of 2020 to 2019, the growth was 920%. This is growth that you're not going to find in any sort of value company. And I think that if they continue acquiring more EMR companies, as they've already acquired 3 this year, we're going to see this growth continue to boom. Maybe not at 920% levels. However, it'll probably grow at 200% levels the next year, and maybe drop to 100% the year after that. But still, this kind of growth is phenomenal for a company of this size. If we look at analyst outlooks on this company for 2021 compared to 2019, over a 2-year period, analysts predict the revenue to actually double from around 32,000 all the way to about 57,000 on average. And the last thing to know about their financials is that they're growing their margins rapidly. From 2019 Q1 to 2020 Q1, their margins increased from 30.7% to 38.5%. And this is all due to their SaaS revenue increasing 920% year over year. The SaaS business is where they're going to definitely see higher margins, and as they continue to grow this through acquisition, I believe their margins are only going to get better. Now let's dive into the qualitative analysis of this company. So the positive things that are going for this company is that the current market is very highly fragmented, which means WELL Health Technologies is in a good position to bring consolidation to this market. Being the first mover in the space, they have an advantage being able to snatch up companies at a lower price. And as they continue to scale up their clinics, the investment that they put into technology is going to become more and more profitable. As technology technically doesn't cost too much to distribute, it's just got a high front-end cost for development. As they continue to attract more outside customers as well as bring in more clinics into their own network, they're going to be able to give better pricing to customers and attract more customers through this. Also, another thing, as they continue to scale the number of clinics they have, this is going to create a quicker feedback loop for the developers of their technology. Because WELL Health is able to implement their own technology into their own facilities and do this quickly without having to jump through 2 different management teams, their own management team as well as an outside management team. All it has to do is go through the internal management team to bring in test software into their own clinics. And those clinics that are owned by WELL Health Technologies are able to provide quicker feedback to the development team, and therefore the whole development loop becomes a lot shorter, and as a result, they're able to innovate quicker than other companies. The EMR business has a good tailwind, as there are still a lot of doctors out there that use pen and paper to record their patients' data. And as doctors continue to retire and new doctors come into the space, they're going to drive the whole technological advancement because younger people are more tech savvy. And as a result, when they become business owners and make the business decisions for their clinics, they're going to be more prone to buying technology products versus their older counterparts right now. Also, another great thing about Well Technologies is their CEO. He's got a very good history as well as done a very good job at running this company. We can see that he's made 6 acquisitions of EMRs, as well as already acquired 21 different clinics all within 2 years. On top of that, he had a successful exit from his previous company, TO Networks, and he's invested $5 million of his own dollars into the company, and he's not even taking a salary right now. So he's got a lot of incentive to grow this business and not just take a salary from the company like a lot of other CEOs. As well as he is currently the largest shareholder, so he stands to lose the most if the company goes under. Lastly about this company, they have a major investor who's very key to this company's success. His name is Sir Li Ka-shing and he's from Hong Kong. He's one of the richest men in Hong Kong, and I think he's like 30th overall in the world. He owns the largest pharmacy chain within China, and this is the Watson's brand. And Sir Li Ka-shing has made investments in 4 of the previous investment rounds that Well Health Technologies has done. So the fact that Sir Li Ka-shing continues to invest in the business clearly means that he does see a future for this company. The next fact that I want to talk about is a bit of a positive and possibly a negative. The fact that they're acquiring companies through cash and as well as issuing shares to buy them. The fact that they're issuing shares is a problem that some people might have with the company. As the company issues shares, this causes dilution to current shareholders. However, the one thing that I think that is okay about the share issuing is the fact that they're buying businesses that are profitable and will add to the bottom line. And as they bring these businesses into their own network, they're able to drive higher margins through these businesses by bringing efficiencies across the entire network. So in the end, although they might be paying a little bit extra for the business, and this is shown in the goodwill numbers on the balance sheet, they will bring operation efficiencies into these new acquisitions and therefore make them a lot more profitable. And these acquisitions not only will grow their bottom line, but also scale the company as a whole and make it more well known. And not all the times do we see shares go down when there is a dilution of shares. Take a look at Shopify. They recently announced that they're raising capital and their stock price was around $1,080 when they announced that. Today, a couple weeks later, it's up at $1,200. Not every time when a company announces that they're issuing shares does the stock price fall. Because dilution can technically be a good thing because the company is using that money to expand their business, and eventually each share will be worth even more because the business is growing faster than the number of shares is growing. As a potential investor that might be interested in Well Health Technologies, there's also some negative sides to the business that we must consider. The first one is that the company is not cash flow positive, so every single quarter they've been burning through their cash. The fact that they have $17.5 million on the balance sheet right now is a good thing. If we look at the cash flow statement, you'll actually notice that they were technically cash flow positive in the previous quarter, and that's because they raised investment. However, this is not sustainable to continue raising investment quarter over quarter. If we look at the operating expenses, this gives a better idea of how the business runs and what are the operating costs on a day-to-day basis. And they actually lost around $435,000. So this is not actually that much compared to the amount of cash they have in the bank account right now. So for the long term, I'm not too worried. However, if their cash flow bleed continues to increase quarter over quarter, this company could be in trouble if this pandemic continues to play out and stifles the entire Canadian economy. If you're a value investor looking for a stable business or dividends, forget about Well Health Technologies, as there is still a lot of risk involved in this business as they're in the growth stages, and this growth can be stopped at any time because there's still such a small player in this space, and there's a possibility of larger players with a lot more capital coming into the space and just dominating. And there actually are 2 competitors that are larger than Well Health Technologies that I'll talk about right now. And these 2 companies are Loblaws and TELUS. And a lot of you will actually know these 2 companies because they're massive giants in Canada. They are currently the number 1 and 2 for EMR providers. And although they are the largest providers, and this is because of the scale of their companies, the one advantage that Well Health Technologies has over these companies is their pricing model. Well Health charges roughly $150 to $200 per physician in terms of a license subscription fee. However, TELUS and Loblaws, they charge around $300 to $395 per physician. And this is because they use a proprietary technology that has a patent behind it. However, Well Health Technologies uses an open source platform. Now let's talk about if I will be buying WELL Health Technologies and what my stance is on this company. So currently I do own some shares in WELL Health Technologies. If you haven't seen my previous video, you can click that right up here, which is on 28 stocks that I own. And WELL Health is in there. I own about 21 shares today, which is a very small position. However, I do plan on going forward and buying more shares of this company because of the research that I've done into it, and I do believe in it in the long run. And I think that this is a very exciting space, and it's a highly fragmented space that WELL Health is positioned to capture a lot more market share. And with a lot of other segments of our economy already revolutionized by technology, the medical space is bound to follow, and especially doctors' offices, which are very far behind. So I think that WELL Health is doing the right move by acquiring clinics to prove out their software in these clinics themselves and using this as a marketing technique to sell to other businesses out there. And although WELL Health Technologies only provides EMR software currently, I think that the software offerings can continue to grow from here. And eventually, WELL Health Technologies will plug in AI into their software system. And this will help them figure out trends within the whole healthcare industry and better service clients, as well as provide statistics and data to their physicians. And this could greatly advance the whole medical industry within Canada. And the fact that the CEO revealed this about their business, that they're going to possibly put AI into the EMR software, is showing that they're thinking ahead in terms of how they're going to grow the company. Another reason why I'm investing in the company right now is the fact that they're a small market cap and the market that they're addressing is massive. The fact that the market is $40 billion and the current market cap is $330 million means that they have a lot of room to grow. And also looking at the breakdown of investors within the company, about 26% of the company is owned by insiders and 8% is owned by institutions. And the reason for this low institution number is because the fact that their market cap is fairly low. For hedge funds and other sort of mutual funds to buy WELL Health Technologies, they're required to have a market cap of maybe $1 billion or more. These hedge funds and mutual funds typically invest in companies that are a lot more safer, and if a company is larger, this usually means that the company is a little bit more stable. So if WELL Health continues to grow at their current rates, I'm sure in no time they're going to attract more institutional investment, and this will only drive up the share price. So as a young investor looking for growth stocks to invest in, I think it's a great time to get into WELL Health Technologies before all the institutions get into it. I also really like the CEO, and I've watched a lot of his talks in preparing for this video. I think he's a huge visionary and he's got a great idea of how this whole sector works and has a vision for the company and how to drive WELL Health Technologies to be one of the leading providers of digital health in Canada. I've included a link in the description below with one of his latest talks on the business, so you can check that out if you're interested in investing in this company. WELL Health also has another tailwind that's playing in its favor, is the fact that this whole pandemic is pushing healthcare to be digitized as well as virtual. With the launch of Virtual Clinic Plus, they're in the position to capture a large market share of the doctors who are scrambling to find a way to connect with their patients virtually. And this will only accelerate the adoption of virtual care within Canada. And lastly, I believe this business has a moat around it. And this is the fact that they're in the medical space and it's very difficult to get into the space and develop technology. And this is due to HIPAA compliance that's required by any sort of medical technology company that tracks data. And data privacy within the medical space is very critical for companies to abide by because medical records are one of the most sensitive pieces of information that a person can have along with their financial information. The fact that WELL Health has already passed these regulations through acquiring companies that have this software, they have this barrier already from a lot of other startups that are looking to get into the space because they've navigated the rough terrain of regulatory approval. And myself, as a previous startup owner in the health space, I know all about this regulatory, and it's a pain in the butt to go through this whole process. And that's ultimately why I left the company, because it's too hard to get off the ground and it takes a lot of capital to be able to invest into regulatory. So that about wraps it up for my WELL Health analysis. If you enjoyed this video, smash that thumbs up button, as well as subscribe to my channel for future videos on stock analysis. If you have any other companies that you want me to analyze or have any questions on WELL Health Technologies, leave those in the comments down below. Keep up the grind and have a great day.